In the personal finance industry, debt gets a bad rap. There are many famous quotes from finance gurus who are against debt. Dave Ramsey says, "Debt is dumb, cash is king." Thomas Fuller said, "Debt is the worst poverty." Nathan Morris said, "Every time you borrow money, you're robbing your future self." The list goes on and on. In general, we are led to believe that debt is bad and we should get out of it as soon as we possibly can. Is that true? For the most part, debt has, in fact, been bad for the American consumer. Millions of Americans are deep in credit card debt that is incredibly high interest. People have fancy cards paid for with expensive debt. But to say that all debt is bad for consumers is glossing over some key nuances that must be examined. In this video, we will do a deep dive on debt and share some insights that are a little contrarian from the conventional wisdom in the personal finance industry. Before we begin, please like this video and hit the subscribe button with notifications turned on so you will be first to know about new content. Our mission at the Personal Finance and AMP Investing channel is to empower people to achieve financial independence. Subscribing will help us achieve that goal. Now, let's get back to today's video. Let's first take a step back and define what debt is. Debt is something, usually money, borrowed by one party from another. It is used by corporations and individuals to make large purchases that they could not afford under normal circumstances. Debt must be paid back at a later date, usually with interest. That sounds simple enough, right? Well, to start, that's what debt is, but there are lots of types of debt. One way to categorize debts are secured versus unsecured debts. Secured debt is one backed by a tangible asset that is put up as collateral for a loan. The loan is secured by that collateral. Common examples of secured debt are mortgages and car loans. With secured debt, if you are too far behind on paying your debt, the lender can seize the debt. For example, with a mortgage, they can foreclose on your home, which means that the lender can seize the property, remove the homeowner, and sell the home to cover their costs of not having their loan paid back. While this may take some time, being evicted from a home is a possible outcome of not paying back a mortgage. Similarly, falling behind on a car payment can lead to the lender repossessing the car and sell it to recover their money. Advantages of secured debt include being able to borrow large sums of money. Why? Because the lender knows that they'll get their money back either by collecting loan payments from you or repossessing the underlying asset. Potential for lower interest rates. There is less risk to the lender as discussed above, so they will likely offer a lower rate. You might qualify for a tax deduction on some secured loans such as mortgages. Disadvantages of secured debt include you can lose the underlying property that secures the loan if you fail to make the payments. A lender can repossess your car if you don't pay your auto loan, but they can't take away your bachelor's degree if you don't repay your student loans. There is less flexibility with a secured loan in that they are for a specific item like a home or car. You can buy almost whatever you want with your credit card. How to handle secured debt. Make the payments on time. Let your lender know if you are struggling to keep up with payments. They might work with you if you are upfront with them, and they might give you some breaks to help you out temporarily. Sell the property if you can't make your payments. For example, if you are about to have your car repossessed, sell your car and pay off as much of the loan as you can. This would help you avoid the cost of dealing with a repossessed car and will prevent the negative impact to your credit score. Unsecured debt. Unsecured debt is not backed by a specific asset such as an automobile or home. Instead, the lender allows you to borrow money based on your perceived ability to repay the debt, also called your creditworthiness. Creditworthiness is determined by your credit score. We will make a separate video on the topic of credit scores to cover that in detail. Typical unsecured debt includes credit cards, medical bills, student loans, personal loans. Although there is no asset to seize if you fall behind on your payments, the lender will report your missed or late payments to the major credit bureaus, which will affect your credit score and consequently your ability to get credit in the future. Advantages of unsecured debt. You don't have any asset that is at risk of repossession. You might have more freedom about what to do with your debt. For example, you can buy most things with a credit card without consulting the lender. Applications for unsecured credit typically are approved quickly. Disadvantages of unsecured debt. This typically comes with a higher interest rate to compensate the lender for the higher risk of not having an asset backing the loan. You may find it difficult to qualify for a loan if you don't have solid credit history. How to handle unsecured debt. Make your payments on time and pay at least the minimum amount due. Contact your creditors if you are behind on payments. They may be willing to work on a repayment plan. Another way to categorize debt is revolving versus installment debt. Revolving debt gives the borrower the ability to borrow against the credit limit over an indefinite period. The available credit is typically fixed, so as you make purchases, the available credit goes down. As you pay it off, your available credit increases again. Revolving debt can be either secured or unsecured. Credit cards are an example of unsecured revolving debt. A home equity line of credit is secured revolving debt. How to handle revolving debt. Watch your spending. Revolving debt is your choice, so buying things on credit card that you don't need could put you in financial hardship in the future. Pay in full each month so you don't carry a balance that is high interest. At the very least, pay more than the minimum so you are reducing your balance over time. If you are having trouble maintaining payments, pay off the highest interest debt before the lower interest debt, as this will save you money in the long run. Find opportunities for debt consolidation where you can take one single loan that is large enough to pay off all your existing loans for a lower interest rate. This could be a great opportunity if you have gotten deep in credit card debt, especially with merchant credit cards that offered attractive incentives but had high interest rates. Installment debt is a loan that provides a lump sum amount of money at the start of the loan. This must be paid back in installments over time, typically monthly, for the life of the loan. Installment loans can be either secured, such as mortgages and auto loans, or unsecured, such as student and personal loans. How best to handle installment debt? Pay on time, every time, in full. Make half payments every 2 weeks rather than a full payment every month. This way, in a given year you will make 26 half payments, which is the equivalent of 13 full payments or 1 extra payment in the year. This will pay off your 30-year mortgage in 22 years. This seems like a significant reduction for a small extra amount, and that is true. The reason is because the extra payment that is made reduces the principal of the loan. Thus there is less interest to be paid in the future, which means the same monthly payment will actually pay more and more of the principal down. This snowball effect ends up shaving 8 years off a 30-year loan and would save $93,827 in total interest over the life of the loan for a median-priced home in the US today. Refinance the loan if you can lock in a lower interest rate. You have to weigh the reduction in interest with having to pay closing costs of a mortgage, but if the reduction in rate is large enough, this will save you a lot of money over the life of the loan. In today's economy at the end of 2022, interest rates are rising quickly, which means that as time goes on, mortgage rates are going up. If your mortgage is at a high interest rate now, keep a close eye on interest rates, because there might be an opportunity in the future where interest rates come down again and you can refinance to a lower interest rate. A third way to categorize debt is good debt versus bad debt. There is not a scientific definition of good versus bad debt, however, there are generally accepted ideas about this. Good debt is defined as taking on a loan to increase your net worth or enhance your life in an important way. Examples of good debt would be: a student loan where you take on debt to get an education which would lead to higher incomes in the future. It should be noted that over time, the cost of higher education has increased dramatically and interest rates on student loans have also gone up. Thus, millions of former students now have huge student loans that they will struggle to pay because the costs are higher than their education provided. This has become a mainstream debate in America, and the current administration is moving towards a controversial student loan forgiveness program with significant opposition. So while student loans are still currently considered to be good debt, there are certain factors that should be taken into consideration, such as the amount of debt to pay for school, and how many years it will take to graduate, the interest rate on the debt, and whether the student will have a job after college that can afford to pay off the loans in a reasonable amount of time. A business loan, which would allow you to start or grow a business to make more money in the future. A mortgage to buy a home and eventually sell it for a profit, or other real estate investment loans in order to generate cash flow. Bad debt, on the other hand, involves borrowing money to purchase rapidly depreciating assets or only for the purpose of consumption. Examples of what are considered bad debts would be: car loans. Cars depreciate significantly the moment they are driven off the lots. Also, there are opportunities to buy used cars at lower prices than new, and it will still accomplish the same objective of getting you from point A to point B. Credit card debt. Most consumers use credit cards for excessive consumption. Yes, it is true that with rewards or points, a frugal user could end up making money with credit cards, but the vast majority of Americans end up buying more than they need or can afford on credit card because it is so much easier to do this than to pay with cash or ensure that they have the money for it before they purchase. Credit cards have caused significant excesses in spending to the detriment of most Americans' financial situations. Debt is a complicated topic, and there are a lot of opinions in the mainstream and personal finance industry about this. What are we to believe? Here is how we at the Personal Finance and Investing channel suggest that you think about debt. First, you should know that overall debt has had a hugely negative impact on the financial health of most Americans. Car loans allow people to get fancy cars that they can't really afford, and credit cards allow people to buy all sorts of things they can't afford. As Dave Ramsey says, we buy things we don't need with money we don't have to impress people we don't like. Even mortgages have contributed to this, as the 2008 housing crisis was caused in part by mortgages that were given out to people who couldn't pay them back, and many went into default. It is important to be extremely careful about getting into debt and doing so for only the right reasons. Second, for those who are in debt, you should work aggressively to get out of debt, as it will be a huge burden preventing you from achieving financial freedom. The mission of the Personal Finance and Investing channel is to empower people to achieve financial freedom. Debt in America is a huge albatross weighing many people down, so in general, we agree with at least some of what Dave Ramsey says in that debt can be dumb. Third, we are not quite as draconian in our condemnation of debt as some, including Dave Ramsey, are. We do believe in some limited application of debt in some cases, but it needs to be very thoughtful and deliberate. Here are some examples. Limited student loan debt to pay for college. So long as the amount isn't too great or the interest rate too high, we strongly believe in bettering ourselves, and getting an advanced education is nearly imperative in this globally competitive economy. Taking a moderate student loan is worth being able to get a degree to be more competitive. Business loans. Loans are not called leverage for no reason. They allow businesses to scale more quickly, which can allow them to grow more quickly. For the most part, businesses have sufficient stakeholders carefully monitoring expenditures and loan payback that most business loans are done wisely. Compare that to the relative lack of diligence that we pay our personal finances when taking on credit card debt. So as long as a business is being prudent in their use of business loans, we support that. A mortgage for a home loan or a real estate investment. Again, this needs to be done diligently and thoughtfully. Don't move into a house that is too expensive, or your mortgage payment will be crushing. At the PFI channel, we believe in home ownership, so we support moderate mortgages to become homeowners. Very limited credit card usage. As discussed above, the vast majority of credit card usage is excessive. However, on occasion, they can be helpful. Putting required expenses on credit cards that have no annual fees and cash back can be a great way to make some money for routine expenses such as paying internet and phone bills. In this way, you are getting cash back for doing what you would have had to do. Groceries can also be in this category, so long as you are really focusing on what you absolutely need to have rather than buying excessive things. Eating out is not really in this consideration, as there is widespread data that when people go out to eat, they spend more than they can afford, buying appetizers, desserts, drinks, etc. In general, be extremely smart and careful with your consumption of debt. It has gotten way too easy to take on debt, and people suffer significant consequences to their financial situation because of it. However, wise usage of debt can be good so long as it is done very carefully and diligently. Let us know what you think in the comments section below. Also, let us know if you have specific topics or questions you want us to address in future videos. Don't forget to like this video and subscribe to our channel so we can help achieve our mission of empowering people to achieve financial independence. Thank you for watching, and we'll see you next time.